So the Federal Reserve's worst nightmare, it's now here.
We've raised the federal funds rate by 500 basis points since a little more than a year ago. We also think that there's more tightening power coming through.
The speed of this hiking cycle is distorting Wall Street and reshaping personal finance in America.
So there's a lot of things happening in the economy, the stock market, and the entire world right now, and it's leaving investors wondering, is it still a good time to invest, or should I sit on the sidelines and should I wait? So the Federal Reserve's relentless pursuit to bring inflation back down to 2%, and the way that they're doing that is keeping interest rates higher, it's now backfiring. So right now there's a lot of evidence out there in the economy that it's slowing down, the unemployment rate is slowly ticking higher, there's more people looking for work that can't find work, and at the same time the Federal Reserve is being persistent to keep interest rates higher for longer, and that is crushing the economy even more. And on top of that, we just got the Federal Reserve's preferred inflation metric, which is PCE, and PCE actually just came in a little bit hot. So as I always say on my videos, I'm here to make money, you're here to make money. Let's break this down in a no BS way of what actually matters in the market, how do we capitalize, what do we do with our portfolios, how do we make money with this stuff. So what I'm looking at right now is this. I'm in the camp that inflation is going to trend down with time, but in the short term, as what Jerome Powell recently said at his press conference, he thinks that there's signs of inflation coming back higher because of what's happening with the tariffs now being priced into the market.
It can be anybody from the exporter, the importer, the retailer, the manufacturer, or the consumer that winds up paying these tariffs. In the beginning, it will be the importer that pays the tariff, but ultimately it will be spread out among those five, each of which will try very hard not to contribute. But in the end, tariff will be paid, and all of the data suggests that at least some of that will fall, not all of it, but at least some of it will fall on consumers.
We have this price level hike because of tariffs. Businesses are now raising their prices, and they're going to pass a lot of that on to us as the consumers. So when they pass that on to us, the price level goes up, inflation goes up, and the Federal Reserve is not as confident to bring interest rates down because they're scared inflation is going to ramp back up higher.
You know, the things that are being sold at retail now, they might have been put into inventory before the tariffs in February or March. So we think we should start to see this over the summer, you know, in the June numbers and in the July numbers. And if we don't, I think we're learning here. If we see less pass-through, there aren't historical experiences we can consult here, really. So it may turn out that the pass-through is less or more than we think.
And there's a lot of controversy happening right now with Jerome Powell and Trump because all Trump says is Jerome Powell's too late. He needs to cut. Usually the Fed's always delayed. They were too late to raise interest rates after COVID, and they're too late to cut right now. The economy is slowing down. Why are we not cutting? Inflation's going down. Why are we not cutting? So there's this big divide, and the Federal Reserve has a huge responsibility because interest rates are everything. Interest rates dictate how much it costs to buy a house, how much it costs to buy a car, how much your credit card interest rate is, how much money that these companies can actually borrow because there's a higher interest rate or a lower interest rate. It matters for everything. And then we have this idea that Trump is probably going to fire Jerome Powell in about a year, and Trump is apparently going to put someone into the Federal Reserve that's going to be willing to cut interest rates lower. But that, again, that could have problems because what happens if inflation comes back a little bit and then whoever Trump nominates to the Fed, they actually go cut interest rates and it makes the problem worse, where we have this inflation that comes back and it gets totally out of control. And of course, all that's possible, but you could see there's a lot of things brewing up in the economy right now that could potentially cause the stock market to crash at a time that valuations are a little bit high right now, but the stock market just continues to go higher and higher and higher. You're going to see the people on YouTube talking about the hot stocks to buy, the people on X talking about the hot stocks to buy, the people everywhere talking about the hot stocks to buy. But when your friend's talking about it, your mom's talking about it, your brother's talking about it, that is a time to start to be careful. Right now, there is risk. There is opportunity. We could make money, so let's talk about it. So before we get started, I have to ask you guys a question, and I would like it if you comment it below so I could see what you guys really think. But I'm going to hold up a piece of paper, and I want you to tell me, would you rather invest in the bond or the stock market at the given interest rate that you're expected to make in each one? So I'm going to hold it up. The bond here is 10%. The stock market here is 10%. Which one are you going to want to invest in, the bond or the stock? If you could get a guaranteed 10% in a bond every single year, that's pretty compelling. But what about the stock market at 10%? It's not guaranteed. There's going to be volatility. There's going to be crashes. There's going to be pumps. There's going to be a lot of things to worry about. Many people would view the stock market as much more risky, and I personally would too. 10% versus 10%, why not get the risk-free return? So the reason why this matters so much is because money wants to find the best risk-adjusted return. Why on earth would you put your money into the stock market and get the same exact return as the bond market, but the bond market is guaranteed as long as the U.S. government does not default? This is a big issue right now because if inflation actually ticks higher and it becomes sustainable, there is a chance that the Federal Reserve is going to have to raise interest rates higher to try to bring inflation down, to try to slow down the economy even more to bring inflation down. And there's problems by raising interest rates, which of course it's going to hurt the economy even more, but the Federal Reserve is going to prefer to bring inflation down over saving the economy from a recession, I promise you. So right now the bond yield is roughly 4.5%. It is not 10%. But the closer this goes from 4.5% to 10%, it's going to be more compelling to put your money into a bond because there's really no risk involved with that. There is risk involved with the stock market. We have higher valuations right now. We have tariffs. We have trade wars. We have Israel and Iran. We have stagflation. We have all this stuff happening right now. And you have to worry about that stuff when you're invested in the stock market. But when you buy a bond, you don't really have to worry about any of that stuff. So this has a lot of investors freaked out. This is why what the Fed does matters so much. It dictates everything. Interest rates are like gravity on the stock market. The higher the interest rate goes, which is usually going higher because inflation's going higher, the higher the interest rate goes, the lower that the stock market's probably going to go because money is going to be more attracted to the bond.
And the yardstick is government bonds. The higher the yardstick goes, and the yardstick is government bonds, the less attractive these other bonds look. And that's just fundamental economics. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
So the Federal Reserve only has three options right now. They cut interest rates, they hold steady, or they raise interest rates. And when you do one thing, you're probably going to hurt the other thing. If we raise interest rates or hold them steady to try to get inflation to keep coming down, you're probably going to hurt the economy. But then if you lower interest rates to try to save the economy, you're probably going to make inflation go higher. So it's like you help one thing, but you hurt something else. So it's a very tricky situation to try to manage if you're the Fed. And on top of that, you have the pressure from Trump, which I'm not saying Trump is wrong by any means. I'm going to tell you my opinion in just a second. But you have Trump hammering you to cut interest rates because every single percent that you cut, you are saving roughly $400 billion in interest that the U.S. government has to pay on these bonds.
We're doing well and as a country, if the Fed would ever lower rates, would buy debt for a lot less. It's a shame. This guy, do you ever have a guy that's not a smart person and you're dealing with him and you have to deal, he's not a smart guy. He's worried about inflation. I said, that's right. If there's inflation in 6 months or 9 months, you lower the rates or you raise the rates. You can do whatever you want, Brian, right? So let's say there's rampant inflation, which there's none. You know what there is? There's success.
So Trump is putting a lot of pressure on the Fed. And I kind of want to pivot a little bit here and talk about what this actually means for the market and what I really think is going to actually play out. Jerome Powell's term ends summer of next year, so summer of 2026. When that happens, Trump is going to interview potential Federal Reserve people and he's going to say, look, I'll put you into this position. I'll appoint you, but only if you agree to cut interest rates. And I know that's wrong to do because the Fed is supposed to be independent from politics, but Trump has the power to appoint the next Fed, and Trump has the power to put in whoever he wants to put in. He's not going to put in someone that's going to stay higher for longer. He's going to put in someone that's going to cut interest rates. And Trump is very persistent that inflation's coming down. He thinks it's going to keep going down. We're oil independent. We could drag the price of oil down, which is going to bring inflation down. We have this tech and AI revolution that's happening right now that's making these companies more efficient. That's another thing that's going to help push inflation lower. So there's all these deflationary aspects that are coming into the economy right now. But Trump is just mad that Jerome Powell doesn't see that yet, and he's staying higher for longer when he should actually be cutting. Now, if it were me, if I were Jerome Powell, I honestly would be cutting right now too. Yes, we might have a very, very temporary bump in inflation for the next few months as this tariff stuff starts to get priced into the market. But it's most likely just going to be temporary. It's only going to be a one-time price level hike once these companies pass this stuff on to us. And most of the tariffs that Trump said were going to go into place on Liberation Day, they're nowhere near that tariff level. I mean, he just said today that China's going to be a 30% import into the US. Yes, 30% is a decent number, but it's nowhere near the 80% that it was supposed to be on Liberation Day. And on top of that, there's loopholes to get around the 30%. There's ways that the companies could absorb some of the cost. There's ways that the consumer could absorb some of the cost. There's ways that the company's corporate profits are going to absorb some of the cost because this pen right here, let's say it costs $1 to get it from China and then you sell it in America for $2. If you have a 30% tariff on this It now costs you $1.30 to import this from China and you sell it for $2 still. So you make 70 cents profit instead of $1 profit. So maybe 15 cents of that just gets passed on to us, and maybe 15 cents of that gets realized in the actual bottom line for the company. So it's not as big of a deal as what people think. And again, it's a one-time price level hike if we even get it. So I'm in the camp that inflation is going to keep trending down as time goes on. Yes, it's going to be bumpy. Not every single inflation report is going to be perfectly straight down to the bottom. But as we go on these months and these quarters and years as they go by, the tech and AI revolution is going to totally revolutionize how we do business, and it's going to make so many of these companies more efficient, more profitable, and more streamlined. That's going to make the costs come down. That's going to make earnings per share go up. And when earnings per share goes up, corporate profits go up, the stock price is going to go up. And at the same time, inflation is probably going to trend down, like I said. And when inflation trends down, interest rates are probably going to go down, which means bond yields will go down. And that's overall very, very bullish for the stock market. So short term, I'm talking like 1 or 2 years from right now, the stock market is a little bit expensive. But if we get drastic interest rate cuts, if we go from 4.5% right now to 3.5% to 2%, the stock market is going to be very, very cheap because interest rates are gravity on the market. If there's less gravity, higher valuations are justified. So what I'm doing right now in my 7-figure portfolio is this. I'm continuing to add shares in my base portfolio. That's VOO, Triple Q, and 20% individual companies. I like Meta. I like AMD. I like NVIDIA. I like TSM. I think all those companies are great. They have a moat. They have pricing power. They're trading below intrinsic value. Now, with regards to selling stock options, I love selling put options. But honestly, right now, there's just not that many deals out there. So I'm selling call options. But again, I'm still selling some put options. I'm just not selling as much. But there is going to be volatility in the market. It's just a matter of time. And volatility equals opportunity. So I'm prepared to capitalize if we go down. I'm prepared to capitalize if we go up. And you should be just like that too. Don't be over leveraged. Don't go YOLO call options right now because the market's going straight up. This is the time to be careful. This is the time to be prepared for the next drop. And if you want to learn more about stock options, watch this video right here. It's going to walk you through my entire strategy. It's 20 minutes long, so don't even click it if you don't have 20 minutes. If you do, it's going to help you out a lot. And on top of that, for the next few days, click the link below. You could get my course and my Discord 100% free. It's not going to be like that forever. I'll see you guys there.